Good morning. I'm going to assume that people can hear me speaking and see me. I'm gonna sound the official starting pig. Excellent. Right. Good morning and welcome to the second in our series of webinars. And I am going to start by allowing all of my wonderful panelists to introduce themselves because notoriously this is something I forget to do and then everyone is mystified as to why they're here and watching these fantastic people. So I'm going to start with the people I can see on my right and Cyrille.
Good morning. I'm Cyrille Gogny-Goubert. I'm a partner at Farley, specialized in real estate and hospitality.
Many thanks. Felicity? See, the starting pig is crucial, really, to all these endeavours.
Hi, rookie error. I'm Felicity Black-Roberts, Hyatt's development team covering Western Europe, all brands.
Welcome. Yannis.
Good morning, this is Yannis Ermilios. I'm working with Colony and in charge of portfolio management for Europe.
Many thanks. And George.
George Nicholas, Global Head of Hotels at Savills.
Wonderful. So we're mostly going to be focusing on M&A in this session and what we're having, where we're having it, what impact this is having on investors and brands. I'm going to start with Cyrille and say, last year wasn't the greatest year for performance for many hotels, and a lot of investors were hoping that they were going to pick up many a bargain, almost to the extent of being promised it seems. And yet at the moment, we don't seem to have seen, apart from a few little deals here and there, most recently featuring Westmont and Invesco, only some little deals on the side. Are we going to see this huge giant bloodbath, or is it just never going to materialize?
Well, it's very hard to say. Currently, what we notice is that the sellers of hotels are expecting very high prices because there is a strong appetite for a hotel investment. On the other side, the buyers want to have bargain and profit on the crisis. And based on the fact that there is currently virtually non-income coming from hotels, and that an income is a good way to value a hotel investment. So until they find the middle ground, there will be not much M&A happening on the hospitality side.
So is it a case that people just can't see 2020? It's all about this happened in 2019, and we're just going to stick with that. Nothing to see here.
Yeah, that's the seller's view, and the purchaser's view is 2021 will be probably worse than 2020, so it needs to be reflected on the price.
Fantastic. So still some static there. I, of course, allowed everyone to introduce themselves and thought that was my responsibility done with, but I've completely forgot to mention that there is a Q&A. If people want to ask a question, I will be monitoring the Q&A. I cannot help you with sound or anything else technical, unfortunately. Only questions about M&A and any knowledge these wonderful people may have. George, is that the position all around the world? Is there still sellers thinking 2020 didn't happen, it was none of my fault, I'm going to get the price I want?
Katherine, I think that's a very sensible question, and what we're seeing is obviously a variety of approaches and understandings of the situation around the world. Obviously, we are, when we look at markets like Australia and New Zealand, where there is very little COVID and a smaller impact of COVID on the hotels market than in other areas like Europe, then the hotel markets are far more stable and offer a more clear prospect as to upside. As such, that means hotel transaction activity has been far more, I would say, lucrative or far more active than in other markets at the kind of pricing that owners wanted. In fact, some recent transactions have delivered surprisingly positive results above book value, and there are some public examples of this right now. Moving on to Asia, there is kind of a muted and very slow transaction activity, as it is in Europe, where there has been some of the transaction activity has been stress related, and indeed that has also occurred in the US. So global transaction activity is down about 2/3, so down to 1/3 of what it was in 2019, in 2020, and 2021. We're forecasting a little bit more, but the shape of the recovery is certainly being reviewed every minute. But it is a lot more positive, I would say. There's a lot more positive sentiment in the market. We're looking at the recovery far more favorably than we were middle of last year. Obviously, the vaccine programs around the world are being rolled out. There's a lot more positive sentiment. We're looking at the light at the end of the tunnel, which last year we didn't know was a train or daylight. It appears that it's daylight right now, and that we're coming out the other side. And that has been reflected in the public equities markets when we look at the share price of our friend Felicity's company, but also in other public companies like IHG, Whitbread, Hilton. They're all at or above the prices and values that they were before they went in, before COVID really evolved and developed. And that's by putting COVID in a box and reflecting on more of a reflection on what values will be and financial performance will be in 2022 and beyond, and really just containing 20 and 21 to something of the past and focusing on future cash flows. So there has been stress, not distress.
I love a catchphrase. Is this IHG and Whitbread, of course, are special cases in terms of they have a big budget focus. IHG has a strong China focus. Both these segments and markets have been quite strong, so you can imagine that their share price has been supported. Felicity, how have you seen the higher end of the sector, and when do you expect to see a huge bounce back? And do you expect to see a huge bounce back? We saw some figures from Barclaycard this morning that said that people may not be spending in the frenzy that everyone hopes.
Yeah, I mean, there is a lot of talk in the market right now of a sort of post-pandemic feeding frenzy in terms of all of this money that everybody's got saved up that they're going to want to spend. It's kind of difficult to comment on individual hotels because in terms of like the different segments, because different hotels have performed because of really micro location factors during the pandemic. So, you know, a lot of our resort properties did very, very well last summer. If there was a particular scientific university function close to one of our hotels, then it did very well. We had some private families staying in some of our very high-end properties, which helped those. So finding a trend across whether it's segment or location is difficult. There are some sort of highlights and headlines. Germany did well because of the domestic market, but it's very difficult to find a consistent trend across brand or across market. We have seen China bounce back really quite quickly and very well. We've got a good network in China, and of course that's a big captive domestic market right now because nobody's traveling.
Absolutely, and I guess when your domestic market is capable of spending cash, that's great. But other markets where the domestic market don't like to do that so much, it's a bit sad. Yannis, where are you seeing opportunity at the moment, and how are resorts in particular faring? Because resorts were the great white hope back in last summer when we were all going to go and lock ourselves away in them, and it was going to be super. And I think somewhere in the West Indies you could have a tracker to make sure you didn't leave the resort, which really is every resort operator's dream. Oh. Hello. Sorry.
So yeah, from an opportunity perspective, I think that considering this crisis is all about liquidity and managing liquidity in whichever hotel kind of typology you fit. The investment opportunity is more into the credit. So providing credit solutions to owners who, I was looking at all the questions, who might not want to sell or to really aggressively dispose their assets. Other opportunities, I think, will also be around this kind of credit or structured credit, at least for more, let's say, opportunistic investors, into funding development plans. Because if we take especially the resort segment, and we have other experts, of course, in the panel, they can confirm that there is a very big trend in accelerating development plans which relate to mainly high-end resorts or resorts which are more eco-friendly or will add an angle which will most probably be very marketable after the COVID goes. Now, if we look at the way that resorts operated last summer, I think the results were more or less satisfactory for most people, especially for smaller properties. There has been in Europe, at least, which in places I know, a certain amount of traveling that did take place. So the operator managed to stay afloat. The governments and the banks help in that direction. And my understanding from the various discussions I have is that this is most probably what is going to happen this year if we consider that the vaccination campaigns, etc., will accelerate in the continent. Of course, more visibility 22 onwards once the whole pandemic will be kind of over.
Is there anywhere that you're shopping in particular?
I mean, we are looking at various opportunities in Europe. I mean, this, it's generally the coastal areas which attract, and then we also think that the mountain is going to be a destination where more and more money and investments will be directed.
So you referred to a question that we have had from the floor from Rod, and George has volunteered to answer it, but I'm going to read it out so everyone knows what's happening. Banks may not be attracted to lending new money to struggling owners, but are prepared to waive covenants or roll up interest charges. If lending rates remain low and the banks are allowing lenders time, why would owners want to sell now? Isn't it a sensible decision to hold on for best times? So I'm going to go to George to see, is this the continuance of pretend and extend, and then to Cyrille to get his thoughts on that. George.
Yeah, but Katherine, I think that no one's pretending. There's no pretension that times are tough, right? And I think everyone understands that the issues that are created around cash flow and serviceability of loans that have created offence of default haven't arisen out of a poor execution of a business plan. They haven't arisen out of fundamental problems with the asset. It's more of it's an industry. It's global, and as such, I think we've seen, certainly in the United Kingdom, in Europe rather, and most other jurisdictions outside of the US, where lending is done on a balance sheet basis and lenders can engage actively with borrowers, and they've been able to work together with them to understand and deeply understand what the issues are facing the cash flow, and therefore serviceability of debt, and ultimately the repayment of the principal. That they get it, and they understand. So we've seen a great and tremendous response from a lot of the lenders now that are working with and extending other facilities to borrowers to get them through this period of time. Where we've seen, and I'll just say, where we've seen lenders that are less flexible, so the special services that act on behalf of a commercial mortgage-backed security facility, they don't have the flexibility and the luxury to be able to sit down and discuss with the owner. They have to sell, right? So those sales are being forced. But to answer Rod's question is, like, would you sell now? I think that comes on a case-by-case basis. I may not choose to sell if my plan was to hold for 3 to 5 years. That said, or longer. That said, we're seeing tremendous transactions that are happening at or above where we thought we would be able to get maybe even a year and a half ago, so prior to the pandemic. So yes, in an absence of a lot of opportunities that tell a good story, now might be a very good time to sell. But if the cash flow or the predictability of the cash flow doesn't hold up to the pricing tests, then it might not be.
We'll come back to why hotels in a bit, but it seems to me it's obviously none of this is hotels' fault. None of this is anyone's fault, unless you listen to Donald Trump, had some theories, I believe. But none of this is anyone's fault. But that doesn't mean that if you need more money, you're not going to have to pay for it. If you don't have a cheery banker. So Cyrille, is this a whole new type of downturn that we're seeing, or is it a we haven't got enough money downturn, or a bad things are happening downturn? Is there anywhere we can compare this to and make ourselves feel better about it?
What I think is that it's not yet a downturn, because governments have been backing loans, have been making efforts on money to be paid to employees, etc. So there are distressed assets, and there are hotels that are closing down every day. That's a reality. But the hotels, well, most of the hotels are being helped. And so far, this delays the fact that they are going into bankruptcy or have to renegotiate the terms of loans and have a discussion with their lenders. I mean, most of these schemes will save hotels on the long run, but not all of them. And that's a certainty. And so the owners and operators that have cash right now have a much better chance of surviving than those that don't. And the hotels that are performing now have a better chance of surviving than those that don't. So it will be a limited downturn thanks to these schemes. However, there will be a downturn at one point. That's a certainty.
Right. And do we know when this is? Because so far we've had sort of 6 months, and then we had Sebastian Bazin at the ACCA results saying, much as you have, that there's lots of government support. So really you're looking at 6 years, and who knows what's going to happen in 6 years in terms of the general cycle. Can we pitch on this, or is it a case of people who are doing badly before, let's sniff around some of that?
Well, the people that have been doing badly before are already in bankruptcy proceedings, basically. And we're seeing more and more distressed portfolio and distressed brands on the market. And there is a strong appetite for that too. I mean, the JJW portfolio, for example, that was on auction at the beginning of the year in France, received 59 offers. The court received 59 purchasing offers, so that's huge. But on the other hand, all the assets that are doing well are not on the market at all.
So this is a sign, I think, of the enthusiasm for hotels. Yannis, do you think when you're looking, you're not tempted to think, well, you know, I'm going to buy more resorts and more hotels because it's still awful. It's still comparatively awful in office and residential, so I may as well go somewhere. And is this what's driving this enthusiasm, this idea that the market is going to shoot back up and hotel offices and residential are going to be rubbish? So if you're investing in real estate, it may as well be hotels.
Well, I think that there are a couple of, I mean, this is, yeah, one way to think of it. And then I guess some investors do that. The other reason, I guess, and we have seen this in transactions where we were sellers, today you have the opportunity sometimes, in especially key getaway cities, to buy properties, meaning locations, which before the crisis it wouldn't be available. So there are transactions which, so assets which transact at actually values which are pre-COVID, just because of their uniqueness and the fact that pre-COVID they would have been traded in a different way or in a portfolio or anyway in a different structure. And then I also think that today you have transactions happening, of course, for the COVID reason, but also because there is a huge amount of liquidity in the market, especially money which is kind of private and which can buy without credit, so without a loan. So, I mean, and George, maybe you can confirm, you can see transactions in the range of 15 to 30, 40 million, which are tickets that very easily a wealthy family office can afford, or a private individual who has cash to put into action. Where I think we see a bit less transactions is in the big numbers, which in any case need support from banks, and where effectively financing like today is not necessarily as easy or as available as before. Even though I think that in the coming quarters or semesters, this will also be changing once we get visibility on what will be the recovery. Now, of course, the opportunities, as Cyrille was saying, is that for people who cannot sustain this pressure, and sometimes they also sell. But I think these are transactions which are, I mean, I wouldn't call limited, but it's not that many, because governments help, banks are open to discuss, and generally everybody's trying to help.
It's very beautiful. Felicity, Cyrille briefly touched on it, but do you anticipate seeing any huge brand consolidation as part of all this? And Hyatt have been linked to a number of deals in the past, and they tried to buy NH. Do you see this as an opportunity that you're likely to strike in?
Yeah, I mean, I don't think it's any kind of mystery that Hyatt is always looking, and if there's things come up for sale, we're often one of the bidders. The last thing we bought was 2 roads 3 years ago now. We still have sort of one of our strategies being to sort of integrate new growth platforms. So, you know, to the extent that there are brands available or portfolios available which would allow us to integrate our brands into those portfolios, then yeah, I can see someone like Hyatt taking advantage of the situation. You know, I can't remember who it was who said it now, there's winners and losers in all of these different scenarios, and yeah, if we were able to buy something, I'm sure we would, but I have no gossip for you.
It's a terrible sadness. So there's not any particular areas of excitement where you're looking, or anything that you want to fill in particular. It's more a case of if this happens, then, you know, we might opportunistically.
Yeah, I mean, I think Hyatt's been very clear about where it wants to sit in the market in terms of concentrating on the luxury lifestyle and upper upscale properties. You know, we're not in limited service. I'm not sure that's a strategy that the board wants to pursue. Mark hasn't called me recently to ask me if we should. Yeah, so I kind of think Hyatt's fairly clear about where it wants to be. I think we've made a bit of a pitch on the lifestyle side recently. I think in terms of what we're doing individually as developers on the ground is we're still pursuing the strategy that we put in place 3 or 4 years ago now, in terms of rolling out the brands and the key cities and locations where we want to be. I think probably the one thing that pandemic has done in terms of Hyatt's business is focused us more on looking at expanding our leisure and resort portfolio to kind of balance out a little bit of the city centre and MICE properties that we've got.
Is there a split that you want to get to for that in particular, or is it just we'll look at that if it comes along?
Yeah, do you know, we don't, you know, we never put out that we're going to have 250 Andazes by a certain year. We kind of tend to grow a bit more thoughtfully and where we can. So no, we don't have a split for it, but the reality is we are so often led by where the market is going, and right now we are seeing a lot more opportunities to grow our brands in some of the leisure markets, frankly.
And are you seeing, before we had all this, there were people talk about accelerating trends, and it's mostly true. Do you feel now that you have to have an extended stay element, or you have to have something so that when you go to an owner and say, you know, I know you've seen for the past year that a government can come along and just shut this asset down and there's nothing we can do about it, but, you know, or we can do takeaway food, or we can have a bit of extended stay, or maybe people can work in our hotel rooms. Do you feel that you have to be more nimble now, and there's more demand for that, and that demand is likely to stay?
It's a super interesting question, and one that we've kind of talked about a lot recently. I think there are kind of two schools of thought. We've got some owners coming to us sort of wanting to redesign their hotel for the future, which is sort of basically predicated on making sure that it's pandemic proof, where actually what as an industry we're all saying is let's get through the pandemic and get on with life. So I'm not sure I necessarily believe in this whole scale pandemic proofing of hotels. But what I do think we'll see is the industry being, on the whole, a lot smarter about how we use space. And different hotels will have different ways of capturing the new normal. You know, we are definitely, whatever anybody might say, we're definitely going to see more home working. As somebody who's worked from home for the last year, I would very happily, if that were to continue, find a local hotel where I can go at least one morning a week and get a change of scenery. Now, is there a property that I can do that, or is there a property that's going to flex its lobby space to allow me to do that? And I think we're going to see a lot more hotels needing to react, maybe to welcome their local communities, to take account of that change. I think we're going to see people who realise they can take extended holidays because they can mix work and a vacation. So we've already started to see people taking suites for a month at a time, for example. And they're doing a bit of holidaying, they're doing a bit of homeschooling, they're doing a bit of work. So, you know, I think people are catching on to that flexibility, and I think hotels have the opportunity to capitalise on creating spaces, new spaces where people want to go.
Yannis, are you looking for more flexibility in your assets?
I mean, broadly, yes. Even though, I mean, the assets which are in the portfolio today, we are mainly looking into, you know, the day-to-day asset management, the way that we keep our liquidity there. We keep up with our obligations and our covenants, and I think that's the key priority now. On a couple of assets where we are planning new capex programs and development scenarios. Yes, of course, and that's also coming from the operators which we are working with.
Yeah. George, are you seeing, as the investors come into the sector and are hoping for this big rebound, are you seeing a change in profile? Are you seeing kind of more education? Are people coming to you saying, I want this asset and I want to know that I can make people live in it for 6 months if I have to keep the money ticking along?
Yeah, I think the interesting thing is we've obviously seen, not obviously, we have seen a new wave of investors emerge just in this post-COVID or in COVID era. There is a lot of rubbernecking going on at the moment. It's kind of like when people slow down to drive past a car crash on the motorway, and you can imagine that
they don't normally want to buy the car though.
Sorry?
They don't normally want to buy the car though in that situation.
No, they don't want to buy the car, but they're, you know, they're just curious to see what's slowing things down, and the point being that out of all the asset classes, out of all the real estate asset classes, hotels and leisure has been amongst the most affected. You can imagine restaurants and pubs, and retail has been as well, and retail has its sectoral challenges and driven by, you know, changes in consumer patterns, but hotels, you know, may see some long-term changes and may not. So there's a lot of attention being paid to the sector at the moment, but which is opportunity hunting. The experienced hoteliers are also looking very heavily to try and understand how they can unlock an opportunity. And those, as Yannis mentioned, the family offices that are in the space are also trying to get access to opportunities that might not have otherwise been available, but have become available or might become available because there's just a general change in someone's investment portfolio in other areas. But the underwriting that is required for a lot of this new capital is trying to solve for high teens, low 20s type IRRs. So that's not really driving transactions where there's generally a low cost of capital. That high cost of capital is putting prices and values or the bid down, and the ask is still fairly high and robust because there is this as I said before, stress, not distress, and banks and lenders are working with the port, with the owners. And we anticipate that gap will shrink over the course of the months to come, and there will be more transaction activity. So to Rod's point earlier, why would you sell now if you don't have to? Perhaps, we don't know which way prices are going. We anticipate that they will come back over the course of the next year to two, but depending on where your asset is and what submarket it's in, it might be better to get ahead of the curve and actually sell it now before there is a wave of distress opportunities forcing prices down, right? That might be a good reason to sell.
Yeah.
But otherwise, I would, reflecting on past event-driven cycles, and we analysed the recovery pattern of 9/11, post 9/11 in the US. We analysed the recovery pattern in Europe post GFC, and we found that values came back quicker than market activity and quicker than performance, and they came back to the same levels as they were before the event, right? So, in anticipation of performance recovery, people bought hotels at the numbers that they were at before. Now, that came coupled with a lower cost of capital and cap rate compression, which drove values up. But there was a period of inactivity which lasted up to about 2 years. So we're kind of in the middle of that now. So we're forecasting that kind of later this year, early next year, we will see that kind of back to where we were, and then it'll be onwards and upwards. We hope. But as Cyrille said, there is still, there's still a question mark over what is the long-term impact of COVID. And while there is active stimulus happening in the market at the moment, once that is withdrawn, what will be the impact of that? Will companies tighten their belts? Will people tighten their belts? Question. Yeah. So, or how to Felicity's point, how will people's travel patterns change? Instead of taking their apartment, for the commuters, the urban commuters, instead of taking an apartment in Paris or London as they commute from Manchester, maybe they give up that apartment and rather just stay in a hotel for the 3 nights a week and work from a week at home. So listen, I think it's going to be fascinating. I think that things will change. We will see more of that business lounge evolve and evolution, where there's sort of co-working type spaces in hotels where people can sit down with a laptop. We will see business travelers stay longer in places because they can work remotely. And perhaps build in a tour into their business travel. So it's an exciting time. But you need to focus on your subcategory. You need to focus on your the geography of your investments as well.
Yes, you make an interesting point about the changes to business travel. If anyone's watching this and has been signed up to Citizenm's subscription model, I'd be very interested to hear from them and hear how that's going, because that certainly looks like a fascinating offering. And
we see Josh Wyatt, who was former CEO and at Generator, is now CEO at a new company called Neuhaus in Los Angeles, and they're opening up this subscription model type office, and we're seeing more companies like Hyatt entering into Two Roads and Hilton developing up their motto, and IHG buying Kimpton on those lifestyle brands. And those lifestyles are very easy to add to that kind of co-working model as well. They're really well set up for that.
Felicity, you're nodding sagely. Would you be happy for all your guests to live with you?
Well, not me personally, no. I haven't got space for them all. But I think George is right, and I think, even if you talk to the circle of people around you, this crisis has made everybody reassess not just what they're doing on a daily basis, but what's kind of the next 2, 3, 5 years got in store for me, and do I need to, be on an aeroplane at 5 o'clock every Monday morning back to London, or whatever it might be? So I do think that we will see the coming together of a lot of individuals making new lifestyle choices. And in the sector of hotels where we're playing, that's certainly gonna have an impact on us. And you know, whether it's maybe a small company gives up their office in London and alternatively they come into London for 2 or 3 days, stay in a hotel, maybe we have to flip bedrooms over to smaller meeting rooms. I don't know what those answers are yet, but I think as an industry we need to have a really open mind to making the changes. I think another thing that I'd like to say in terms of changes that the industry's made is, you know, we have accelerated technology a lot, and we have seen the acceleration of kind of contactless check-in and all of those things. And I think as an industry, as we move out of the pandemic, we really need to make sure we put back in contact and human contact, because that's one of the things that makes our industry so special. And people will, I think, need that and will respond to that. So I think that's a kind of interesting dynamic as we maybe morph how we use spaces. We also need to think about how we're interacting with people again.
Yes, I saw an ad that on the Metro only this morning saying live in a hotel for a month for €900. It's less money than you pay for rent. And I thought, these are valid points. We have a couple of questions from the floor. So I'm going to go to Cyrille with, is there a chance hotels could be overpriced over the next 6 to 12 months as a result of increased demand for them versus underlying fundamentals, which remain questionable, may take 3 to 5 years to recover? Could crisis buyers be overpaying? And I'm going to add in, back to your point about government support. If I was an investor looking for somewhere that might be a good bet, I would be thinking, on the one hand, hotels is not so great with the shutting them down. But on the other hand, quite a lot of governments piled in to bail them out. Not the UK government, but other governments certainly did. So, you know, maybe there's some structural support that we can lean on here. So, Cyrille, are people overpaying?
Well, it's of course hard to say. They might be overpaying because there might be not that much income coming in the future in these hotels. But on the other hand, what we noticed throughout various crises and various types of crises in the hospitality industry is that it's very agile. So every time there's a crisis, every time there's a terrorist attack somewhere, every time there's a pandemic, a financial crisis, the hospitality world reinvents itself and then bounces back. So and we can see that every time. So yes, they might be overpaying because it might be a long-term crisis, but on the other hand, they might not be overpaying because most probably the hospitality world will bounce back in the future.
And this leads us seamlessly on to the other question that we have, which is relating to KKR's acquisition of Rumpot last year. This was the biggest deal in the sector last year, and it was for luxury self-catering product. So I'm going to ask everybody, is this something that people will carry on looking for? Are we all going to be luxury self-catering? I'm going to start with Yannis. Fancy a bit of that?
Yeah, sure. No, I think that yes. I mean, if you see the performance of the really top-end luxury retreats, at least in Europe, and I mean, it happens that I've seen some numbers, they completely outperform any other year before in terms of ADR or FPAR. So, in my view, yes, as I was saying before, there will be a trend which will move the holidays to something a bit more, you know, environmental friendly and nature related, etc. Whether it's in the very high top end, and then generally this is how it starts, and then, you know, the remainder is following. That I think it's personally, I think that this COVID experience is what will kind of change things into an overall mentality thing, going more healthy. And then it will affect the way we work, the way we travel, the way we live. I mean, especially the big cities, hospitality, of course, and then our holidays, because as Cyrille was saying, I cannot imagine that people will stop going on holidays. It's obvious, and that was always the case in the past with the wars, with whatever. So
how's that? So before I get to the others on luxury self-catering, how's the COVID going to change the way that you travel?
Now, first of all, it makes it way more difficult, especially today with all the tests that you need to take to get in, to get out, to spend quarantines. If you go to a place and you're coming from another place, sometimes you need to stay in a, if I was to go to Singapore, I would have to stay 14 days in a hotel room. So, and then you get back, you have another 10. I mean, if you need a month to do one trip, it's kind of complicated. I think that in the coming months, actually, with the vaccine campaign that is taking place everywhere and the discussion about the vaccine certificate, some of the traveling will be definitely easier. But today, travel between countries or sometimes and continents for sure, it's pretty complicated.
When things are better and when this is all passed, are you going to run amok?
Of course.
No,
the only difference is, I think the only real difference which relates to the office space and to the hotel space and everything is that this crisis proved that many things can be done remotely or can be done through the digital kind of world. But again, the human interaction is necessary in every working environment. So I cannot imagine that this will stop. Now, the fact that people will try to leave maybe like out of the cities, or at least the big cities, or will eventually companies will try to, minimize cost by using space, expensive space in a different way. Or I do think that, the smart working kind of solutions of co-working and out there will take the lead. But I mean, that the companies will need an office. I mean, even from a tax and domiciliation purpose, to operate that, I mean, for sure. And you need to have, an interaction to make sure that the teams are there, the bonds, everything. That we will go back to that at a certain degree, but most probably not as it was before.
No. George, luxury self-catering, fun times, or just because people can clean their own rooms and they're concerned about chambermaids during COVID?
Yeah, I suspect it'll be the success of the product will vary from country to country, and it's certainly not new, right? I, for one, have been, well, what I would think is luxury self-catering for the last year. So the last thing I want to do is cook for myself when I go on holiday. But I can see how certainly it would be an attractive option for those that are concerned about it or want to have a different experience. Hyatt was in it for a while, I guess. Through an investment in One Fine Stay, they decided to get out of it. That's got bought by somebody else. The luxury self-catering option is available on VRBO, on HomeAway, on any number of different online booking engines through houses and whatever. So I think it's not new. It's there. What is interesting is obviously KKR have got an idea for the growth of that business model. But what we've seen is kind of almost at the other end of the spectrum, the end that is far more voluminous, is the Blackstone's acquisition of Bourne Leisure in the UK, which is a very, very big acquisition. It's multiple billion transaction, supported by Starwood Capital through the and that is a model that has scalability. That's a model where you change the room rate by a couple of pounds. There's a material impact to the bottom line. I think through not a whole lot of investment, they can increase the bottom line on that acquisition, and certainly roll it out. They did it with Center Parcs. They can do it with Bourne. So at the leisure end, at the discounted end, I think that there is certainly a lot of scope for that. And that's not just the UK. It's not just Europe. Obviously, in the States and in the Australian New Zealand market, it's a tremendously successful business model. We just haven't seen the institutionalization of it in many other markets.
Yeah,
it's coming.
I concur with your luxury self-catering, although I think it's been more mid-market at my end of things. If that. It certainly is the days we're on. Felicity, I'm not going to ask you about luxury self-catering because, as George has pointed out, you guys don't do luxury self-catering anymore. But to go back to previous comments that you were making about development, how easy are you finding development at the moment? And how has the relationship been with owners? If you find yourself having to make different contractual changes, are they more demanding now? How's the approach been?
Yeah, so in terms of owners, I mean, obviously we're also an owner ourselves, and we own real estate around the globe, and also in quite a number of joint ventures. So we're feeling the pain along with everybody else, and we're, you know, having to, especially with the joint venture properties, we're putting a lot of work in to make sure that, you know, us and the joint venture partner are aligned, and the asset is protected and safe. So, you know, yeah, we've had to put a lot of work in, that is for sure.
Is that or money, or how does that look?
Yeah, it ranges depending on the asset and how it's financed, what the nature of the joint venture is. So, you know, looking at everything from, you know, the refinancing, bank debt, etc. So we've had to address, we've had those, everybody else has had those problems, we've had them ourselves too. Obviously, in terms of our management contracts and franchises, then yeah, it's working as far as we can with the owners. You know, we've got hotels that have opened, closed, reopened, closed again. So it's providing support to those hotels and providing support for those employees, frankly. I mean, it's at a hotel level, to be an employee right now is really tough. And, you know, it's uncertainty for them. So certainly there's been a lot of activity on the owner side and helping people through, you know, talking about what they might want to do in the future, how we see business coming back. So a lot of dialogue. I think in terms of new stuff coming into pipeline, we're seeing a very small number of new developments come forward. We were lucky enough to sign an Andaz for Lisbon last year, and the Hyatt Regency for the Olympia project in West London. So those were two new developments that we did get signed. But the majority of our pipeline is conversions. Quite a few independent hoteliers now coming to us saying, yeah, we would like to be aligned to a brand as we come out of this. So that's where we will probably see a lot of activity, and that's where some of the kind of softer collection brands come into play.
And is that enthusiasm for the brand based on lender requirements, or based on your fantastic distribution, or what's pushing that? So they just feel safer?
Yeah, I mean, I think there's a lot of lender push in there. Lenders certainly feel that if the asset maybe wasn't necessarily performing to market previously, post-pandemic, going with a brand is a good option for them. So there is some lender push in there. I think as with everything, everybody's assessing what their options are and what the future looks like, and I think that's making people question what they've previously done. And yeah, Hyatt is one of the largest, least represented brands in Western Europe, so we're seeing some benefit of that at the moment.
So cool, Felicity. How are you seeing terms in contracts? Are you having to be more flexible? Is anyone making any unusual demands?
Yep. Flexibility is key. We are basically just, when it comes to terms, people say, oh, can you tell me what your terms are? I actually just say, let's sit and talk for about half an hour and really understand what's going to work for you, because everybody's got a different pain point. So there's no point in me putting a term sheet together without spending some time with the owner of the hotel to really understand what it is that they want from the relationship and where their pain pressures are right now, whether some people want key money, some people are really looking for some form of owner priority because that's helping with them with the banks. You know, yeah, and of course we're being squeezed alongside everybody else, and you've got to take some of the pain with people.
Running into, we've got some more questions from the floor. From Rod, again, lots of great interaction from Rod today. Will an internationally world recognized vaccination certificate be fundamental to the resumption of cross-border corporate and leisure travel? I know some people have had vaccines already in the UK and got a sticker. It's probably not enough. Will we see an internationally recognized certificate? Do you think? Yannis?
Look, for the corporate segment, yes, for sure, because it will just allow you, I mean, the way I understand that, it will allow you to travel faster through the lanes and the queues, and go back to the way that the frequent travelers were traveling before, so making kind of more efficient the controls of the airports, etc. For the leisure ones, I'm not necessarily sure. It depends, of course, between which countries someone would like to move, because when you go for holidays for a long period of time, you can afford to spend a bit more time in the airport.
But, yes, having some tests.
Yeah. So but again, in theory, yes, it's also, I guess, the psychological element, which of course it's a pretty delicate issue, and obviously the fact that some people will not have done the vaccine doesn't mean that they will have to be discriminated or not be able to travel. So I guess governments are working on this thing. But broadly, yes, I think it's going to be important.
Cool. And so we've got 7 minutes to go, and I am making a point with this. It's not just there's 7 minutes to go, so start thinking about your coffee. There's 7 minutes to go, and we haven't got to ESG yet. And I think that this is relevant that I've left only the last 7 minutes, because it feels like the sector, after an initial flurry of look at all these dolphins in Venice, we've all moved on largely from Greta and her issues. Who knows where she even is these days? But it's bound to come back. So Cyrille, are investors still interested in this, or are they still thinking, I haven't had any income for the last year, I'm going to consume as much non-recyclable plastic as I can possibly manage?
No, I think they're very, very interested in this, more and more interested in this, and it's not going to change. And it's not going to change from many reasons. The first one is because you've got legislations and regulations that enter into force to apply the Paris Climate Agreement, and especially in Europe now, you're going to have to integrate the fact that your hotels will have to be energetically perform better. Another reason is that the clients themselves are looking for more environmental friendly ways to travel and enjoy their stays in a hotel. And we're seeing a boom in environmental friendly hotel chains. And the final reason is a marketing reason. It's much easier to market a fund that appears to be environmental friendly and pursue good practices to investors. I mean, it's a plus. So there is really no reason why they wouldn't go that route. Even if it's a bit more expensive, on the long run, it enables the investors to raise more money.
Mm. George, are you seeing investor demand for ESG?
Yeah, to Cyrille's point, and I imagine that Yannis is acutely aware of the capital raising process, and now, you know, when you're out there raising money for your next fund, whether it be hotel or logistics, you certainly have to have that front and center. No longer is it relegated to, you know, the back pages of a PPM, a private placement memorandum. It's very much an integral part as the endowments and insurance companies and so on look to allocate money into funds. So for those type of investors, yes, it's tremendously important. And we've seen companies like Felicity's and IHG look to take quite significant steps towards that, from anything from removing little non-disposable or disposable soap bottles through to water and energy consumption. It's definitely important. And the HAMA, which is the Hotel Asset Managers Association, is really pushing this as well.
Mm. Felicity, where does ESG sit within Hyatt now? Is it something that comes in for all the finance people to take a look at, or is it still something that's on the edge in marketing, or where is it? Where would I find it?
Yeah, you'll find it front and center, to be honest, because it's been there for a while for us. You know, we've been pushing it with owners for a long time, and really trying to explain to people the benefits of an upfront cost and how that can help their hotel in terms of running costs. Because operationally, if you implement a lot of these measures, it actually makes some sense long-term economically. It's just putting the pain up front. And I think anything which pushes that agenda is helpful. I think at a hotel level, you see a lot of enthusiasm on the ground from individual general managers taking their own initiative to implement whatever it might be that's relevant for their location. Is generally a hot issue wherever it might be, and I think that's actually really quite important as well, because if you take a lot of people on the ground and you empower them to start to make individual decisions to make their hotel greener and more sustainable, and actually then you add all of that up, it becomes quite the end sum is enormous. So sometimes when we try and pull these things together for presentations, it's like, oh, this GM did this here, or this GM did that there. And you can actually feel, well, it's all a bit fluffy, but actually when you pull it all together, it's absolutely not fluffy. There's a groundswell, and it's coming from the bottom, and it's empowered by the people at the top. So I think it's a great way forward. And, you know, George has got kids of a similar age to I have. You know, the generation that's coming in behind us are more aware of this issue. The number of times I get hauled up by my 11-year-old for doing something which isn't environmentally friendly, and they're taught this stuff at school and it's drilled into them. So this isn't going away.
You say that, but my 8-year-old would always much rather get a cab than be encouraged to use public transport. So despite all the lecturer, it seems practical application isn't what it could be. How hard has it been to keep owners enthused about this additional investment over the last year? Have you seen that drop off at all? Is it something you've parked? You want to come back to when people have got more money, or has there still been the impetus?
I think there's still the impetus. I mean, to be honest with you, we haven't seen a lot of people delving into new hotel developments in the last year, frankly. So they've had bigger problems on their hands. You know, I think the funding issue is going to drive it on the one hand. I think the wider public agenda, the marketing agenda, I think it is going to continue to gather steam, and obviously political will with the Paris Agreement, and the EU at the moment have got a huge push on environmental issues. If you follow the EU website, you'll see what some of the stuff they're putting out at the moment. So it's there and it's on the agenda. So I think as a company, we need to have robust policy, and we need to have a good reason for selling that, just as we sell the other aspects of our brands to people.
Absolutely. I'm going to close by asking Yannis, as part of the changes to our probable travel trends in the coming years, do you see ESG being part of that? Will we see less casual travel or not?
I think it's very difficult to predict.
If only people could predict things successfully. I find it very irritating when they can't.
Yeah, no, I honestly don't know. I mean, I do think that people, generally speaking, is really putting attention to that in everything, whether it's shopping at a supermarket or raising a fund. Now, the travel patterns will go back. I mean, we are, you know, humans like to travel, to engage, to go around, and the environmental part will be there as well. But you know, travel will get back to our daily lives the way it was before, for sure.
Katherine, can I jump in there and say I really hope so, but I'm afraid not.
Yeah.
You know, I hope that people are far more conscious of you know, their impact and carbon footprint, or whatever the case may be, use of plastic or whatever. I'm afraid that in 2 years' time, or in a year's time, once all of our friends and competitors and friendly rivals have been vaccinated, that we'll fall back into a lot of old travel patterns that we had before.
I have a suspicion that you may be right, but hope springs eternal. And so to allow everyone to get back to their daily lives, I'd like to thank my panelists for what has been a very interesting panel this morning, and thank you all for attending. If anyone has any comments, then do please direct them to someone else. Thank you all very much for your time. Thank you, ladies and gentlemen.
Thank you.
Thank you very much.
Bye.
Bye, guys. Thank you.
Bye-bye.
Bye.
Bye. Bye. Bye.